We know you're looking to get up to speed quickly on building wealth, managing risk, and, well, Jim Cramer's name comes up a lot.
It certainly does. He's got that investment trilogy, Mad Money, Stay Mad for Life, and Getting Back to Even. Quite a bit of material there.
Exactly. So we've waded through them for you. We're going to pull out the core ideas, the stuff that seems, genuinely useful.
Right. And whether you're deep into individual stocks or maybe managing a broader mix, we think the principles underneath, they've got some legs. We'll try to keep the jargon light.
Yeah, focus on the practical. Our mission today basically is find the actionable steps for wealth building, smarter risk handling, how to think about bouncing back from downturns.
And adapting Cramer's ideas for potentially better returns, especially given how things keep changing in the markets.
Okay, sounds good. Let's jump in. Core wealth building. Where do we start? Mad money.
Yeah. Mad Money, Watch TV, Get Rich. That's the 2006 one. A big thing right off the bat is his homework doctrine.
Homework doctrine. Okay. Sounds serious.
It kind of is. He really hammers on doing daily homework for your stocks, checking earnings, who's running the show, what's happening in their industry.
Daily, huh? I know some folks debate, like, the exact time needed, that hour per week per stock idea.
True, the specifics get debated, but the core idea, researching what you own, that seems pretty solid, wouldn't you say?
Oh, absolutely. You got to know what you're buying. Makes sense. What else from Mad Money?
Risk-Tolerant Segmentation, that's another big one. He separates mad money,
Your play money, basically.
sort of, yeah, your speculative cash. He separates that from your retirement money, which needs more conservative handling. It's a built-in way to think about risk.
Okay, I like that. Mentally separating the bets from the serious savings. But how do you actually do that? Like, practically, does he say?
Yeah, he talks about using different accounts or, at minimum, clearly earmarking parts of your portfolio so you can take those flyers with the mad money without, blowing up your future.
Gotcha. Keep the risk contained.
Exactly. She also has the lightning round protocol in that book, the fast takes on stocks.
Oh, yeah, famous for that.
It is. He gives a quick snapshot of his thinking. Though it's worth noting, some academic types have pointed out that rapid-fire stuff can sometimes add to short-term market jitters.
Okay. So maybe treat those lightning round picks as starting points for your own homework, not just blind buy signals.
That's probably the smarter way to look at it, yeah. It ties back to his own homework doctrine, really.
Okay. So moving on. Stay mad for life. Get rich. Stay rich. What's the shift there?
Well, the title gives it away a bit. It's more about preserving wealth, growing it long-term, thinking across your whole life.
Lifecycle investing, is that part of it?
That's a key theme. Tailoring your strategy as your goals change, as your time horizon shrinks or expands.
Right. Like, you probably shouldn't be investing the same way when you're 25 versus, say, 65.
Precisely. Early on, maybe more growth focus, more risk tolerance. Later, maybe income and preservation become more critical.
Makes sense. And diversification comes up there too, I bet.
Oh, yeah. Big time. He stresses it, much like any professional money manager would. Don't concentrate your risk.
Like that Edelweiss mutual fund stuff we saw mentions using funds for professionally managed exposure across lots of stocks.
Exactly. It's that idea of not having all your eggs in one basket.
Yeah.
He also talks about planning for the next generation in Stay Mad for Life.
Okay. Thinking longer term.
And dividends. There's a whole chapter called Dividends. The best offense is good defense. He sees them as crucial for steady income and a bit of a cushion when things get choppy.
Defensive, right. We'll probably hear more about dividends later too.
Definitely. He also introduces his 25 new rules for a post-crash world in this one. Actionable ideas for changed markets.
Which leads us nicely into the third book, Getting Back to Even. Sounds like it's focused on recovery.
Very much so. It's about pulling yourself out of a hole after big losses, and he draws on his own experience there, bouncing back from a pretty nasty hedge fund hit in the late 90s.
Wow. Okay. So what's the core message? What do you look for when the market's down?
He gets specific about stock characteristics in downturns. And again, dividends are highlighted. Income, stability, maybe some upside potential, even if the market's flat or down. That's the idea.
Okay, so taking all three books, Mad Money, Stay Mad, Back to Even, what are the principles that kind of cut across everything? The stuff that applies even if you're not picking individual stocks?
Well, that homework doctrine, for one, research is research, right? Doesn't matter if it's a stock, a fund, whatever. You need to understand it.
True. And the risk segmentation. Knowing your tolerance.
Absolutely universal. How much risk can you stomach? How should that translate to your portfolio? Everyone needs to figure that out.
And the long-term view seems pretty consistent, too.
Yes, that's in Cramer. It's in the Edelweiss perspective. Patience is key. And adapting. Those new rules show up because markets change. You can't just set it and forget it entirely.
It's interesting that Edelweiss point about bankable management. That sounds a lot like Kramer constantly talking about checking out the CEO and the leadership team.
It's the same core idea. Who is running this ship? Do you trust them? Do they have a good track record? It matters.
And Edelweiss also kind of nudges even conservative folks towards considering stocks with research and a long view, which fits Kramer's whole get in the game message.
Yeah, it aligns. Empowering people to build wealth, but responsibly.
Okay, let's make this more concrete. You mentioned case studies showing recovery tactics.
Right. So Kramer's own fund,
Mm-hmm.
making 36% in 2000 when the tech bubble was bursting. That's a testament to discipline, probably avoiding the hype, maybe even shorting some stuff. That's from getting back to even.
36% during the crash. Wow, okay.
Then there's a story, I think, from Mad Money about the investor who clawed back 2008 losses by buying Bank of America when it was like $5 a share.
Gutsy move, but it paid off. Shows the opportunity in turmoil if you've done your homework.
Exactly. And think about his call to avoid Lehman Brothers before it went under. That saved people serious money.
Underscores checking the fundamentals, right?
Absolutely crucial.
Yeah.
What about earlier crashes? Well, the timeline in getting back to even mentions him being entirely in cash during the 1987 crash. Talk about risk management. That positioned him to buy later.
Smart. Sidestep the carnage.
And his own 1998 hedge fund issue. Losing big, then recovering by getting back to his core trading rules. That's a powerful lesson right there about discipline after a setback. It's in real money and getting back to even.
Okay, so these examples show it's possible. Now, how does someone listening implement some of these ideas? What are the actionable steps? You mentioned a cash rule.
Yeah, the 25% cash rule. The sources don't detail it exhaustively, but the core principle is keeping a decent chunk of cash aside.
Why? What's the benefit?
Flexibility, mainly. It's risk management. If the market tanks, you have dry powder to buy things on sale. You're not forced to sell good stuff cheap. You can actually be a buyer.
Okay, cash gives you options. Makes sense. What about sector rotation?
He doesn't explicitly call it that in these excerpts, but when he talks in Stay Mad for Life about finding opportunities or his 12 stocks to watch, it implies shifting money between different parts of the economy.
So like moving from tech to energy or healthcare to consumer goods, depending on what looks promising.
Exactly. Trying to be where the growth is or where things are recovering based on the bigger economic picture. It requires staying plugged in.
Which brings us back to...
The homework discipline.
Yeah.
Yep. Can't escape it. Daily ongoing research, earnings, management, industry trends. It's the foundation in Mad Money and runs through everything.
Okay. Now, I heard mention of worksheets or tools he suggests for stress testing portfolios.
Yeah, in Mad Money, he suggests things like a debt repayment tracker, understanding your own financial health, and simulating how your portfolio might handle historical downturns.
Yeah.
Sort of kicking the tires.
See how it holds up under pressure.
Right. And then in Stay Mad for Life, there are tools more focused on post-crisis assessment, a recovery strategy worksheet to plan your comeback after losses, a risk reassessment tool to figure out how much risk you should be taking now, and even an options and new tools template.
Options, that sounds a bit advanced, especially for recovery. Is that for everyone?
That's a good point. Options are complex, definitely risky, probably not for beginners. He likely includes it as, another potential tool in the toolbox for more experienced folks looking for specific strategies, maybe hedging or leverage during a recovery phase.
So focus on the basics first. Got it. All right, putting this all together, how do we adapt these ideas to actually try and maximize returns, especially after a crisis or in like the weird markets we sometimes see now?
Well, those 25 new rules from Stay Mad for Life are specifically designed as a framework for adapting, thinking differently when the landscape shifts.
Okay.
And that book also talks about putting the pieces back together. Basically, after a hit, you need to systematically review everything, your assets, your allocation, and make deliberate changes. Don't just freeze.
Be proactive, not reactive.
Exactly. He talks about staying proactive in the New World Disorder, his term in Stay Mad for Life. It means continuous learning, staying informed, being willing to shift gears when needed.
So it's not just a fixed set of rules forever, it's principles you adapt.
That seems to be the core message running through it all. Keep learning, do the work, manage your risk, trust good management, and be ready to adjust. Whether it's Cramer's take or the Edelweiss view, those themes echo.
Okay, so wrapping up our deep dive into Cramer's trilogy, What are the big takeaways?
I'd say 1, homework is non-negotiable. 2, actively manage your risk, know how much you're taking, maybe segment it. 3, adapt your strategy for your life stage and the market environment. 4, learn from mistakes, yours and others.
And keep cash for opportunities, dividends for defense.
Right. Those are key tactical points he stresses. His style is, well, it's Cramer, high energy. But the principles underneath offer solid food for thought for almost any investor, I think.
It's about taking control through knowledge and discipline.
And adapting, always adapting.
Okay, so here's a final thought to leave you with. Cramer really bangs the drum for active management, picking individual stocks. But we also see trends, especially with younger investors, towards things like sustainable investing, ESG, maybe alternative assets, stuff outside the traditional stock market focus.
The landscape is definitely broadening.
So the question is, how do Cramer's foundational principles, the homework, the risk management, the adaptability he preaches, how do those fit into this wider, evolving world of investment options? Something to think about as you shape your own approach.